There's a clause waiting inside your superannuation account right now that you've probably never read, let alone used. $300,000, more than most Australians accumulate in super across an entire decade of steady contributions. And it's tucked behind one piece of legislation that's been quietly written into the Tax Act since 2018. It's quite possibly the single most valuable rule in your entire super fund, and it's the one you've almost certainly never been told about. Here's why that's not an accident, and here's exactly how the rule works, through what happened to one person the day she almost missed it entirely. Sarah is 44, sitting in her car outside her accountant's office, staring at a number that just landed in her bank account. $180,000. Her share from the sale of the 2 physiotherapy clinics she spent a decade building. She says the number out loud once, like saying it might make it feel real. In the next 10 minutes, roughly $40,000 of it is about to disappear to tax, unless someone tells her about the rule from a moment ago. She's about to find it. And by the end of this video, so will you. So here's the real question this video is actually about. If this rule is legal, free, and open to almost anyone under a certain balance, why does almost nobody use it? To answer that, we need to rewind 5 years before Sarah ever sat in that car. Most people think of superannuation as a bank account with a different name. It isn't. Super is a tax structure, a wrapper built around an investment portfolio, taxing earnings at a maximum of 15% instead of the marginal rate you'd pay outside it, which for many working professionals runs north of 39% and above $190,000, as high as 47%, including the Medicare levy. That gap is the entire engine behind everything that follows, and the government caps how much can pass through that 15% door each year. That cap is where Sarah's story actually starts.
The cap is called the concessional contributions cap. As of the 2026 to 27 financial year, it sits at $32,500, covering employer contributions, salary sacrifice, and any personal contribution you claim as a deduction. For most people, that cap goes mostly unused. Employer contributions alone might fill $9,000 to $15,000 of it. The remainder doesn't roll over. It doesn't refund. It simply expires the moment the financial year ends. Unless, and this is the part almost no one reads past the fine print to find, your total superannuation balance was under $500,000 on the 30th of June the previous year. If it was, you're allowed to carry forward any unused cap space from the past 5 years and use all of it at once in a single financial year, stacked on top of this year's normal cap. That's not a loophole in the sense of something being exploited. It's a feature the government built deliberately for exactly the kind of moment Sarah is about to have. Nobody's getting paid to tell you this exists. There's no company selling it, no fund advertising it, no product wrapped around a rule that costs nothing to use. That absence of incentive is exactly why it stays this quiet. And it's the reason the answer to this video's opening question turns out to be simpler and colder than most people expect. Right now, Sarah just needs to walk back into that accountant's office. Here's what almost happened. Sarah nearly didn't make that call. The sale had already settled, the money had already landed, and in her head, the tax was already fixed. A done deal. Nothing left to do but hand over whatever the ATO was owed. Most people, at this exact moment, would have felt the same way and simply moved on. She calls anyway, and hears Priya's voice go quick and businesslike, the way it does when she's actually found something. One question nobody had asked Sarah in 5 years of having a super account. Have you ever checked how much unused cap space you're carrying? The answer? Roughly $82,000, built up over 5 years of steady, unremarkable employer contributions that never came close to using the annual cap. Combined with this year's $32,500 cap, that gives Sarah $114,500 of contribution room, all usable right now in this one financial year. There is, though, one condition standing between Sarah and this entire strategy, and it's less a caveat than a cliff edge. The rule only works if her total super balance was under $500,000 on the 30th of June before. Sarah's balance, $310,000. If it had been $500,001 instead, $1 over a line she'd never even heard existed, none of what happens next would be available to her at all. No partial benefit, no sliding scale, just a hard stop. $1. Whew. That's the entire margin between $300,000 and nothing. She's under it. She contributes the full $114,500 into super as a personal deductible contribution. On the tax difference alone, pulling that income out of the 39 to 47% bracket and into the 15% super rate, Sarah saves somewhere between $35,000 and $45,000 in tax in the time it took to make one phone call, using a rule that's been sitting in law for the better part of a decade, and that her accountant has to explain to most clients from scratch every single time. She doesn't celebrate. She sits in the car park a while longer, doing the math again to make sure she read it right. Not from excitement, more from disbelief that something this large had been available the entire time, for the cost of a 10-minute conversation. But the tax saving isn't actually the biggest number in this story. That number is still 21 years away. Picture two versions of that $114,500, both starting today, both invested in the same diversified growth portfolio, both growing at the same underlying 7% a year before tax. The only difference is which side of the tax wrapper the money lands on. Outside super, that 7% gets taxed down every year, some of it as income, some as capital gains eligible for a discount on long-term holdings, landing at an effective 4.5 to 5% after tax. Over 21 years, until Sarah reaches preservation age, it grows to somewhere around $300,000. Inside super, earnings are taxed at a maximum of 15%, but that 15% only bites each year on realized income and realized gains. Much of a long-term growth portfolio's return sits in unrealized capital growth, which isn't taxed until the asset is actually sold, sometimes years away, sometimes longer. Factor that deferral in, along with the discount applied to gains on assets held over 12 months, and the effective annual drag lands closer to 6.8 to 7%, not a flat 15% haircut. Over the same 21 years, that compounds to somewhere closer to $470,000. Watch that gap. Same money, same market, same 21 years. The only variable that changed was which side of a tax line it sat on, and that gap alone is roughly $150,000 to $180,000. Add back the $35,000 to $45,000 Sarah didn't hand to the tax office that day, reinvested over the same period, and the total advantage of that single decision lands somewhere between $270,000 and $330,000 by the time Sarah turns 65, from one phone call she nearly didn't make. She won't feel any of this happening day to day. There's no alert, no milestone notification, just a number, compounding in the background of a life that otherwise looks completely ordinary, right up until the day she actually opens the statement again, near retirement, and sees what one phone call she almost didn't make turned into. A few things worth being precise about before you go looking for your own version of this. This is a composite story, built from patterns in the ATO's own contribution statistics, rather than one specific individual. The numbers are realistic, not guaranteed, and nothing here is personal financial advice. And the cliff you just saw cuts both ways. The 5-year carry-forward window is rolling, so unused cap space older than 5 years has already expired. And once a large concessional contribution goes into super, it's generally locked away until preservation age, currently 60, for anyone born after mid-1964. This isn't a strategy for money you might need in the next 15 years.
Legislation moves too. The concessional cap has changed multiple times in the past decade, and the rules around very large balances have already tightened once, with more changes regularly debated in Parliament. What's true in 2026 may not be true in 2036, which is exactly why this tends to get used in a specific window. A high-income year, an inheritance, a business sale, rather than something to plan around indefinitely. Anyone considering this should talk to a qualified accountant or advisor who can check their own total super balance and contribution history before acting. That call is, in the most literal sense, what made the difference for Sarah. So, back to the question this video opened with. If this rule can add hundreds of thousands of dollars to an entirely ordinary retirement, why does it stay this quiet? Partly it's visibility. Most super fund apps and annual statements don't surface unused cap history anywhere obvious. It exists, but it's buried behind a login most people only open once a year, if that. Partly, it's timing. The rule only becomes valuable in a specific moment. A windfall, a bonus, an inheritance, and superannuation is rarely what anyone's thinking about at exactly that moment. It usually takes an accountant
who happens to ask the right question at the right time, the way Sarah's did.
And partly, it's incentive, or the absence of one. There's no product to sell here. No new fund, no fee-generating account, no commission for anyone who tells you about it. In an industry built on advertising financial products, a rule that requires none simply doesn't get advertised. The strategy costs nothing to access. It only requires that someone knows to ask the question in the first place. Most people never do, not because they weren't paying attention, but because nobody ever told them there was a question worth asking. Sarah's story isn't unusual because of the clinic she sold or the number that landed in her account that day. It's unusual only because, for 10 minutes in a car park, someone thought to ask about 5 years of contribution history before the money was locked into a tax rate she'd never get back. That check takes about 10 minutes today through the ATO online portal inside MyGov, updated automatically every financial year. Most people who look find some unused space waiting there. Most people never look. And now you know exactly why. If there's one thing worth doing after this video, it's checking your own total super balance and your own unused concessional cap history. Not eventually, this week, because that 5-year window is already running, whether you check it or not. If this is the kind of thing you want broken down before you have to find out about it in a car park at 44, subscribe Aussie Wealth with Prince. There's more of this coming. And tell me in the comments, is there a rule like this one hiding in your own super fund that nobody's ever explained to you? That might be exactly what we go looking for next.